Good morning, everybody. How are we? James, how are you today, sir? You well?
Yeah, good. Thanks, Lee. Not too bad. Finally got some
Happy,
sun.
mate. Happy New Year. There's a fine line as to when people say you can continue to say Happy New Year, and when you have to just sort of rein it in a little bit. We're 16 days into the year now. Stop saying Happy New Year. Do you have a fine cut off where you say, look, anything beyond the 10th, and we're moving on with our lives?
I think first couple of weeks you're all good, Lee. So
Yeah.
I'm not taking any offence or anything. Happy New Year to you too.
Cheers, mate. Good stuff. Look, we might be a little bit behind today. It's been about 3, 4 weeks since we've run a webinar. And I was saying to you a minute ago, I'm looking at my screen thinking, where did I used to have this? Where did I used to have that? And we just need to get back
Yeah.
into the flow of things, right?
Well, we started, you know, Zoom world on Zoom, and then we've switched to Teams now as well. So whenever I go back on Zoom, I'm like, oh, I've totally forgotten where everything is.
Yeah, yeah, yeah. I agree. We do a lot of work on Teams, but when it comes to our webinars and whatnot, Zoom seems to be the platform. We have looked around at what other, because look, you'd think in today's day and age there'd be a new platform for hosting webinars, but it seems that Zoom are just staying at the forefront at the moment. So we're sticking with Zoom for another year, unless something comes along and absolutely blows it out of the water. But look, thank you everybody for joining us for the first webinar of 2026. As always, we planned for the today's webinar to run for the full hour. James is with us. So if you've got any questions, please do put it in the chat function, or you can use the Q&A section if you want to be a little bit more anonymous. We do have 2 polls for today's webinar as well, so please do participate and input your answers. That would be amazing. As always, I'm a big pusher on feedback, feedback, feedback. When you leave today's webinar, there will be a feedback form for you to complete. Just let us know how you found today's session. It's the only way that we can improve hosting these sessions. It's the only way our collaborators can improve in delivering the session. So please do just let us know your views and thoughts. We're big boys. We can handle the truth, James, right?
Yeah, I can. Yeah, for sure.
So look, let's kick things off. I don't want to take up too much of your time. So I know you've got a ton of stuff to get through. I have hit next slide. So as soon as the clicker decides to play a game, which is absolutely not doing, so I'll use the old school mouse. Look, just touching very briefly on the club. 90% of people set up and they're very good advisors. They lean in and move towards becoming business owners, and those two things are completely different. Running a business and being an advisor are completely different things. Being a business isn't just about having a name and a brand. It's about everything else that comes with it. It's about the type of business that you're building. It's about the processes, the systems, the tech stack. It's about the CIP. It's about your marketing. It's about your business development. It's about absolutely everything. And sometimes we get a little bit sidetracked and we take our eye off of what's important to us. The club can step in and give you that guidance, give you that clarity, and give you that accountability to build the business that you want to build. Um, we've got a real big range of club members as well. So I think our largest club member sits at around 60 employees. So a good sized firm, well established, if you like. To our smallest is a single advisor running their business as an AR, not even as a DA, but even as an AR, you're still running a business. You're just really using compliance and IT under a network, if you like. But fundamentally, the pillars are still the same. What business are you trying to build here, and are you sticking within your lane? So if you're exploring new opportunities this year and you want to take your business to a new level, or you want to overcome some hurdles, speak to the club, because you're not the first person to go through these changes. Somebody has absolutely been there, done it, and got the t-shirt. Just touching real quick on this sort of stuff. We do have a community outside of the members for business owners, which is a community for absolutely everybody. Some of you may be hanging out in our WhatsApp groups at the moment. Some of you may be listening to our webinars. Most do come to our face-to-face events. Again, podcasts and everything else. So no matter what role you play within a financial planning business, you can still hang out with the club and network with like-minded people. We are on tour this year. These are a few dates that we're going to throw out there for you. The 13th of March. It was the 20th of March, but somebody has decided, not mentioning no names, Lewis Byford, to have a birthday. How selfish of him. on the 20th of March. So we're going to move our Manchester event to the 13th of March, and then we're in Bristol, Edinburgh, and London. So to give you a little bit of an insight as to the club events, they are exclusive for business owners, whether you're a DA or an AR. It's somebody that's wearing every cap within the business. The agenda is absolutely stacked, what we go through with you all. Firstly, we're going to kick off a real personal motivator session, really enabling you to rediscover your why. It's a really interactive, personal motivator session that gets you really thinking about you and why you set your business up. We then look at strategies to win and retain clients across multiple generations. And we're finishing off a session with building and retaining clients across multiple generations. So look, it's a good day, good sessions, 5 hours of CPD, and it's completely free to come along. Again, in the feedback form, there is a section that will ask you, do you want some more information? So please do let us know. Got a couple of webinars coming up that I'll touch on. Next week, we are with FE Fund Info. So this session looks at how AI is really impacting advisor workflows, where it's saving time, where risks can creep in, and how to use technology to really enhance advice without losing that professional judgment or client trust. So really excited. We can talk until the cows come home about AI and tech within this industry. So it's a really good interactive session. We are then back with Bear Rock. This is about complaints prevention. So this one is really focusing on how firms can really spot early warning signs, reduce compliant risks through better processes and communication. And it's about understanding what the FCA expects when it comes to complaint prevention and governance. Governance is a massive word at the minute, James. We're talking governance with you guys. We're talking governance with Bear Rock. It's governance, governance, governance. So look, these are CPD accredited as well. So do come along for another hour of CPD next week and the following week and every week thereafter, Fridays at 10 o'clock. Next slide, please. Why is the clicker works? It stopped working. Here we go. Just touching briefly on our collaborators, we couldn't do what we do without the wonderful support of all of our collaborators. So everybody plays a massive part in supporting not only the club, but all of our community and all of our members as well. So a huge thank you and a big shout out to everybody that is now collaborating with the club. So look, today's webinar. We asked you all some questions upon registering for today's webinar, and I'd like to share that back with you all as well. So we've got a broad mix of attendees from planners, directors, proposition leads, business managers, and everyone in between. So James today is joining us, director at Albion. So James leads the development of the tools and models that advisors use to design and govern their investment propositions, working closely with advisors to turn really complex investment governance into something practical and usable day to day. James, was that right? Is that you, or am I talking about somebody else?
That's right, Lee. That's me. So thanks for the intro there.
No worries. Look, many firms have highlighted that strengthening governance is a priority for 2026. The main reason firms change their investment proposition come down to performance, cost and value, regulatory pressure, and better alignment with client needs. I think overall, it's clear firms are moving away from that set and forget towards more regular reviews and clearer accountability. How have you found the industry, throughout 2025? Are you seeing a bit of a shift now, would you say, James?
Yeah, I think it never seems like a big sort of wave all at once, but there's definitely evolutions every single year, whether it's changes in the product that's out there, whether it's the regulator. There are these little bumps that come up that mean quite a lot of people change all at once, but regardless, it's incumbent on us to make sure we're trying to do the best for our clients. So that will be a lot of the themes of what I'm going to talk about today, and happy to see some of the points raised there because that's consistent with what we thought. So that's good.
It just goes to show you are getting the same information that we're getting as well. So that's reassuring for both of us, right? So look, the floor is yours. I will stop sharing my screen. It is over to you. Just a big thank you to everybody that's joined us today. I hope you all enjoy the session.
Great. So hopefully, Lee, you can see my screen and everyone else can see my screen. We
I've
all
got it
good?
all, mate. It's all you.
Great. Well, just echoing what Lee said, thanks so much for giving up your Friday morning to listen to me talk about ongoing governance. But the title of today's webinar is Beyond Set and Forget, Keeping Your Investment Proposition World Class. So hopefully you get something out of it. And as Lee's mentioned, please do feel free to ask questions along the way. So before we start, then just a very brief intro on Albion and who we are and who I am. So my name's James. I've been in the industry for about a decade now, working for a small firm called Albion down in Exeter. We're a team of six, and we help IFAs, mostly in the UK, but also a handful abroad, build, maintain, and communicate a first-class investment proposition. And we've been doing that for coincidentally 25 years today, which is pretty amazing.
Happy birthday.
So thank you very much. Happy birthday, Albion. I'll hold my hands up and say I wasn't there 25 years ago. That's all down to Tim Hale, as you see on screen. So kudos to Tim for a quarter of a century of Albion. But there's some QR codes on the screen and whatnot if you want to reach out to us and connect with us. So today's session, we're going to be talking about why an investment proposition is not a set and forget process, and quite key because setting up a proposition in the first instance can be quite resource intensive, and you're really trying to strive for the best for your clients. But there are all sorts of reasons why an investment proposition needs maintenance through time. So we're going to talk a little bit about some of those. We're then going to be talking about the investment committee and their role. So the core role of the investment committee is that ongoing maintenance and that ongoing process of challenge. So I'm going to talk a little bit about who might be on the investment committee and what do they get up to. Talk about what's manageable and what isn't. That is ultimately going to be dependent on who you are as a firm, but hopefully we can give you some ideas. And then finally, insourcing and outsourcing. We're going to touch on that too. Starting then with why your centralized investment proposition is not a set and forget. Now, this is a non-exhaustive list. There are all sorts of reasons, but I've tried to boil it down to some of the key ones. And the first big one is there's an ongoing evolution of the evidence out there. And this sort of timeline on the screen has probably boiled down modern finance into one screenshot somewhat unfairly, but there you are. You could argue modern finance started in the 50s with the likes of Markowitz and James Tobin. We've got Bill Sharp's CAP-M, lots of behavioral insights from Schiller and the likes of Richard Thaler. There's Farmer and French's 3 and subsequently 5-factor model, and then lots of work on the fixed income side too on term and credit. For what I've said there made absolutely no sense to you, that's totally fine. Like it's a huge minefield, and there's an absolute plethora of academia out there. I could have mentioned hundreds of other names, but ultimately you do need some process in place, whether it's insourced or outsourced, for trying to stay on top of the latest and greatest. And just throwing a couple of arrows up on the screen there, as I said, Albion's been in this for 25 years now, and we've had a broadly similar philosophy throughout that 25-year period. We're what we call systematic investors. We accept the market works. That's our sort of founding pillar of what we do. There's all sorts of other bits around that, but in that 25-year period, the portfolios we built 25 years ago look very, very different to today, and that's at least in part due to this ongoing evolution in the evidence. And I can tell you for a fact that in 25 years' time, when we turn 50, the portfolios again will look very different to how they do today, because of this ongoing evolution in the evidence. Another point is a change in your goals, and we obviously build and implement model portfolios, and that's a big part of the centralized investment proposition. But you do need to have some goals for what you're ultimately doing, and those goals may be static through time or they may change. And an example of a goal you might set for yourself, it might be a sort of relative to inflation type expected return, where you're trying to achieve, inflation +1, +2, +3. You might be trying to beat some other benchmark. You might be trying to match a benchmark. There's all sorts of risk and return goals you're probably going to set for a sensible portfolio, and those goals may change through time for whatever reason. Perhaps you started with an approach to match a benchmark, and you've been through a 3-4 year educational program with your clients, and you feel that ultimately they're comfortable enough and sort of well versed enough now in the investing world to take on a little bit more risk, and therefore you feel comfortable in adjusting that goal and saying, well, we can probably earn a little bit more here by adjusting our goals. Alongside goals are constraints. Constraints may be quantitative too. Things like volatility, tracking error, drawdown. I won't bore you with what those things mean, but they may just be qualitative points that you, as an individual, as an investment committee, as someone who's representing your clients and trying to do the best for them, it may be something that you just don't feel comfortable with. And that is totally acceptable and fine as well. We're not robots at the end of the day. We're individuals, we're human beings. We have you have huge behavioral biases that make us ultimately quite poor investors, really. But the role of the investment committee, at least somewhat, is to try and keep people, keep bums in chairs and keep people sat at the table. And sensible constraints might be, individual stocks. It might be countries. It might be constraints around how long you want to lend for, whatever it might be. But you do need a process in place to monitor said constraints. So just as a total hypothetical, the US is always a big talking point, but right now seems to be a very big talking point with being a large part of the global equity market. Say in a hypothetical world that continued and you looked at your portfolio one day at the investment committee and the US was 3/4 and you just felt totally uncomfortable with that, despite the fact that's the market price. You felt uncomfortable with that. You decided as an investment committee to reduce that exposure by bringing in, an ex-US fund of some description, and you've dialed that down. And regardless of what the sort of, I say, robotic evidence might say, if you were a robot, we're behavioral beings. We feel more comfortable. Clients are going to feel more comfortable with that. That's going to keep more people, on board. So perfectly reasonable, and again, having a process is key. This is a big one, and certainly one that's been pertinent in the Albion community in the last few years, and that's an evolution in the products. The product landscape in the UK and abroad, for that matter, is a total minefield. There are products launched every single day. I think I read that there's now, in the active ETF space in the US, there's now more ETFs than stocks. So that's just one nugget. But there's around 350,000 open-ended mutual funds and ETFs globally. There's 800,000 investment opportunities globally if you start to include some of the more non-traditional vehicles, investment trusts and hedge funds and all that good stuff. This is a screenshot that sort of, I guess, is our tool. We've been doing this for 8-9 years. Our tool that helps get down to best in class products to be delivered in portfolios and deliver on those goals and constraints that we mentioned earlier. But regardless of whether you're using a sort of sophisticated process like this or maybe an off-the-shelf product, or even there are free products out there to help with screening, there needs to be some paper trail there to say, this is where we started, this is where we got to, and this is why we've chosen these products. And obviously those products evolve through time. So sometimes you're going to get products come through that screening process that do move the needle. They do make a material difference to your clients. So this hypothetical on screen is, you're probably not going to get so much of a slam dunk as this one these days, because competition is fierce. But hypothetically, we've got two tracker funds here, two index tracking funds. This is dummy data, so before we try and guess which two funds they are, But you can see that the top fund, which is the proposed fund, seems to have a lower cost. It seems to be a more established, larger fund, and it seems to be tracking its benchmark better than our incumbent fund. So here we've got an opportunity to get a fund that's doing a better job, is cheaper and more established. It's incumbent on us at the investment committee. Spoiler alert for the next section. Um, to review this and to assess whether we feel this is material enough to make a change on behalf of our clients. And you might not make a wholesale change for a basis point where everything else is equal, but something like this, you'd probably want to be thinking about a change here. Flipping into perhaps a more hands-on approach. So I said at the top, Albion sees the world in quite a defined way, if you like. We are what we call systematic investors. We broadly accept the market works. That's not the only way to see the world. There are all sorts of different philosophies out there, and these sorts of sliders on screen maybe represent a more hands-on approach. You could call it, I guess, a more traditionally active approach. There's lots of ways to do this, and we accept that there are others out there with different philosophies to us. So, if you are in that part of the industry, then you're going to have your own preferences too, and there may well be externalities that come up that mean you have to review where you're at the investment committee level. So here we've got a hypothetical desire for a market timing type approach. Perhaps it's a sort of tactical allocation type strategy. Since last we met, we have reviewed, and one of the funds in the lineup in your model portfolios has moved to a more sort of stock pickering type approach, maybe more concentrated bets in a handful of stocks. That's not your desired approach, and therefore you either need to adjust your desired approach or you need to make changes to the portfolio because your preferences are not currently being met. Obviously, flip side is you may have an internal change in the process, whatever that might be. A longer term to a short term view, trying to be blind to an index or broadly replicate an index. There's all sorts of preferences there, and there's going to be externalities and internal changes too that mean changes are required. The final one, then, everyone's favorite, is the regulator. Some of the sort of initiatives from the regulator are shown on the screen there, in at least in the last few years. It's not necessary that necessarily true that the regulator is going to say, you must use these funds, you must do this, you must do that. But there are certainly themes that have come up in the last few years that have led to changes within the Albion community for sure. So things like the rise in ESG screened funds in 2020 to 2022 and the subsequent release of the SDR regs, and obviously where we're at with the FCA on that is sort of more clarity to come, I think. But there are certainly clients within our client base that wanted to try and build a portfolio to make steps in the right direction and align a portfolio with one's values. And so that is an example of where both the market combined with the regulator has led to changes to an investment proposition, or at least maybe it was a second set of portfolios, but ultimately you needed to evolve and meet that need with clients. There's obviously another couple on there, MiFID II, Consumer Duty.
James, just a quick one. We've had a question come in that relates back to when you mentioned that your investment philosophy concludes that markets work well. What did you mean by that, and can that change?
That's a great point, Lee, and yes, absolutely, it could change because that's just where we stand today. It's incumbent on us, Albion, and all of our clients to challenge our approach, and we'll talk more about that in the next section. But in a nutshell, a systematic versus a more traditionally active type investment philosophy, we're not trying to necessarily beat markets. We feel strongly that certainly over the long term, markets do a pretty good job of pricing, assessing information and pricing stocks and bonds. So trying to second guess whether or not we should have, more in these stocks or more in this sector or less in this sector, or we should be out of markets and back into markets is for us, the evidence is pretty clear on that that's only going to erode our chances of success as
Mm.
investors. So everything we do starts with what does the market price tell us about the future? So that's I guess the difference to a more traditionally active approach where you're ultimately trying to second guess where the market is currently.
Yeah.
Does that make sense?
Yeah, absolutely, mate. Appreciate that. And thank you for the question. Any more questions, just fire away as and when they come to your mind.
Definitely, definitely. Well, I think Lee, we've got a poll now, which is exciting. The first poll being, I believe it was around the most challenging things that you find in the ongoing governance process. Oh, there we are.
We
Look at that.
do
The tech
indeed.
works.
The tech is working. Mate, would you say that there is any aspect of a business that firms overcomplicate when it comes to governance? Is there something that people fixate on? Do they overcomplicate it? Does it need to be as challenging as people are finding it?
No, definitely not. It doesn't need to be as challenging as we make it. I think there's all sorts of answers I could give. I think one that springs to mind immediately is feeling like change needs to happen almost for the sake of it. Like you're not necessarily doing your job if the portfolio is not changing all the while, and it's just not the case. It might be that you do a very rigorous review at the investment committee level and internally and conclude that no changes are needed. And certainly,
Yeah,
if you're building a portfolio for the long term, that makes sense. So that is certainly one thing that I think is an overcomplication. It's like change is seen to be good and seen to be doing the right thing. And obviously, I've just been through loads of slides that says there are all sorts of reasons you may need to change, but that's not to say, you need to be meeting every month, every quarter, fiddling around with portfolios that aren't necessarily moving the needle.
yeah. How often do you think you should be meeting, reviewing, and
We're
reacting?
actually coming
You're
to that
coming to
in
that.
in the
I'm getting
next
ahead of
slide.
myself.
So
Stop it, Lee.
it
Stop it. Okay,
it,
don't answer that. Save it.
it okay.
We've had a lot of people answer now, so that's good. What I'll do, I'll just end the poll, and it's no surprise really that I'm just going to share it back for the audience as well. Keeping up with regulation, it's a forever going, it's a forever moving goalpost regulation. People do tend to react as soon as some new insights and news is announced. Investment research is 50-50 split between those two. Documenting decisions as well. And the one person that finds it all just extremely dull.
Yeah.
I hope you're outsourcing.
Shout out to that person. That's
Yeah,
that's good. I did put
hands
that in
up,
there. I was
completely
like,
honest, it's so dull.
yeah, yeah,
And
yeah.
it's not a bit of me.
Listen, it is parts of it are extremely dull. I mean, I'm that's why Albion exists because we don't find it dull, but we understand that it can be. That's for sure.
Yeah,
Yeah. Listen, those answers don't surprise me, and hopefully, as we move on, I can give you some ideas around how we certainly could help, but also there are lots of tools and others out there that can too.
definitely,
Um,
definitely. Thanks,
shall I
mate.
close this?
I'll stop sharing that, and then you can carry on.
Cool. So we've spoken about why maintenance is required. We're now going to talk about whose job that is. So um, we're going to look at the investment committee. Who are the investment committee? Starting with that question, and ultimately, the investment committee is anyone who is close to the centralized investment proposition and involved in its delivery to clients. Now, primarily that's going to be advisors, but it might be power planners or support staff as well that are involved in writing out to clients, whatever it might be. Certainly, if you're a larger firm, there might be a CIO or an investment team, executives, board members, and any others at the firm. As I said, that it would be prudent and reasonable for them to be involved and make decisions or at least hear why decisions are being made at the investment committee level. Um, there's probably going to be maybe some external visitors on the investment committee too. These are not necessary, but they can certainly add value. So, independent consultants, obviously, that's where Albion sits, but there are others out there. We sit on around 150 to 200 investment committee meetings a year. So we see it all. And there's consultants out there that are in the economics world. There are consultants that are in that's probably the more active side of the industry that can challenge the approach as well. And we sit on investment committees where both of those people are there. And it shouldn't be an echo chamber, the investment committee. You're there to make sure that that tire kicking process is as robust as it can be. So those people can add value, then absolutely they should be welcome at the investment committee too. Compliance, be it someone internal or external. Obviously, there's lots of external compliance functions around as well, but certainly important to make sure you're ticking that box too. Um, and then there might be perhaps you outsource parts of your investment value chain, whether it's maybe it's the operational side around execution. Maybe you've got a bespoke MPS or an outsourced MPS. You might need to have someone from that firm there as the ultimate sort of the ultimate regulated entity responsible for the portfolios. So that's Execution Co Limited, I guess, as an example. And then maybe industry peers. So um, we actually work with some groups of clients that sit at a group investment committee level. We work with some firms that have, product providers come and deliver an insight into a product that's either used by the investment committee or a product they're considering for inclusion to help them better understand it. So industry peers probably wouldn't be regular investment committee members, but they'd certainly appear every now and again to help the investment committee with that ongoing governance process. So a bit of a snapshot into what you could expect. What's the investment committee ultimately responsible for? Well, challenging the process is the first one, the primary one. You want to that blank sheet of paper where you started with, however many years ago it was, you arrived with a set of portfolios at that point in time. You're trying to make sure that is still the best you can do for your clients. So we want to challenge that process. We want to monitor and manage risks. We want to reaffirm the products used in the portfolios, being the first instance, but also to make sure the combination of those products together is delivering on our goals and our constraints for clients. And then obviously making sure we're regulatory the regulatory compliance is ticked as well, and that we're satisfied that we're satisfying our regulatory duty to clients as well. I think this is time for the second poll, Lee, which is how often does your investment committee meet? So maybe we'll run that first, and then I'll give you a view on how often.
So my question that I asked is one of the polls, stupidly, typical of me, that one. Aside from setting dates in stone, are there other things that need to trigger a review as well, James? So is it performance issues? Is it regulatory shifts? Is it something else?
It's rare that our clients would meet sort of as an emergency because of how they invest, which is sort of long term. But we've certainly had more clients either get discretionary powers in-house or outsource discretionary powers to a third party. We actually have an offering in that space these days. So, and when you're in that world, things like, if you've got a mandate that says we're not going to let our portfolio drift by 5% or 10% or whatever you've got in that mandate, then if markets move so that is violated, then it's probably incumbent on you to have a meeting and say what's our plan of action here.
Okay.
But beyond that, not really. Like, I've never really experienced emergency investment committee meetings, but it's a great question.
Um, so again, quite a few people have shared their opinions on this. Is there anything that jumps out to you? I mean, is every 2 to 3 years too far fetched? Is quarterly too often?
Interestingly, we neglected to put the most common answer from the Albion community as an option. So that's quite interesting. But yeah, quarterly doesn't surprise me, and then annually as well, reasonably popular. We don't, I'd say every 2 to 3 years. That again could seem reasonable depending on your approach. There's probably no wrong or right answers. It's dependent on your approach ultimately. So from the Albion community, we got 75 clients. Two-thirds of them meet every 6 months, so twice yearly. Around 30% of them meet quarterly, and then obviously the handful of others some other variation yearly, and I think we have one that does every 18 months, which is always a bit of a strange one.
Yeah,
But
yeah,
but there you are.
yeah. They couldn't quite put their finger on whether they wanted to do it a year or every two
Yeah,
years. So
yeah. We see them, yeah, like every other summer and every other winter type thing. It's quite a
yeah.
strange one. Um, so as we go through the next couple of slides, hopefully you'll see why, depending on your proposition, you may need to meet more often or less often. But before that, we're going to talk about the governance budget. Governance budget then is a mix of your knowledge, your time, and your financial resources. Every firm, doesn't matter what they do, has a governance budget. Albion, we have a governance budget. We need to balance, servicing the needs of our current client base with trying to grow as a firm, with trying to enhance the tools that we offer and build new tools from the ground up as well. So that's our sort of governance budget. And for an advisory firm, you guys have all sorts of different requirements on put on you by clients, by the regulator, and it's only getting more complicated. That's for sure. And we really do um like one of the things we get most joy out of at Albion is freeing up time for our clients, because we know advisors time an advisor's time is limited, and there has to be experts in investing, in tax, in financial planning, in accountancy, in law. It's too much. It's a lot, and really is difficult for any one individual to do properly. So ultimately, there's this governance budget, and you have to choose how you spend it. And I guess the point we're getting at here is, for us, and from our view of the world, like, you're if we can free up time for you, or if you can use any of the insights that I'm giving you today in this webinar to prevent you from looking at boring models on a PC that we love doing, and free you up to service your clients more frequently, or to even go out there and win new clients, then everyone sort of wins there, because ultimately it it's there's never going to be enough advisors to service the industry needs. Really, we know how many people out there need advice, and as an industry, we're always striving to try and service more people and try and grow as an industry. So balancing those three inputs, your knowledge, your time, and your financial resources, is crucial to trying to work out what's manageable and what isn't manageable for the investment committee. So what is manageable is ultimately going to depend on how you're investing, how your centralized investment proposition is structured. We've used a sort of rule of thumb, I guess, with a large firm and a small firm. It obviously is not that simple. It's far more complex than that. But the point we're, I guess, getting at here, or the point I'm getting at here, is if you're a huge company with an insourced investment team, maybe you've got a group of investment uh, like investment CFAs on your firm, and they're the investment team. They might have the capability to have a more hands-on approach and be able to more regularly review the proposition, and so that would be probably more manageable. That kind of more hands-on approach would be more manageable for that larger firm. It might be that you're a large firm and you still don't have time for that, because you're focused on the financial planning process, or you're focused on growth or winning new business, or whatever it might be. Um, smaller a smaller company, certainly in our experience, you're going to struggle to have that really hands-on approach and do it well, because It's difficult enough to have a sort of more long-term systematic type approach, as I've mentioned. There's a lot to that, and there's even more to, as I said, a more hands-on approach. So perhaps that's not manageable, but again, dependent on the firm, dependent on their philosophy. So what would be more manageable for perhaps a smaller firm than a firm that wants to focus on growth? Well, I guess something like a more strategic, a long-term asset allocation type approach. You set up a suitable asset allocation to match some goals that meets your constraints as a firm. You go out and select products that meet those asset allocations through your product screening process, and then you keep those products on watch alongside your goals and constraints. And that is all very manageable for a firm of any size, particularly if you've got the support of some of the tools we're going to talk about in the coming slides, or an independent sort of third party. You can see here just an example, a couple of the funds being on watch for whatever reason. So moving on to the last section in the investment committee, then we're going to try and give you a sense of what an investment committee meeting might look like. And the responsibilities are not limited to some of the ones on screen, but things like monitoring risks, challenging the process, reviewing the portfolio structure and the incumbent funds, screening for new funds, and then finally reaffirming or revising the process depending on what's been discussed. So that is a whistle-stop tour of what an investment committee may look like. I'll whip through this and give you a sense of how an investment committee might go. If you're looking at an investment committee in the diary and it feels like a real headache that you have to get through, that it certainly doesn't have to be that way. I mean, you can do this stuff in a couple of hours once you've been through it a few times and you almost know what to expect and you become more well versed in this sort of stuff. Like it really doesn't have to be that much of a headache. So reviewing previous minutes and previous actions, it sounds like an obvious one, but it is absolutely an important one. We've seen firms throughout the years really benefit from having that audit trail, that paper trail in place that says, where were we however many years ago, where are we today? And we can literally pull out, we can pull out that audit trail and show ourselves, new firm members, our clients, the regulator, that's the process we've been through, that ongoing process of challenge. And that job of recording meetings and documenting minutes is obviously becoming more and more easy and efficient with the likes of AI tools, Copilot and Otter. If you wondered whether we'd get through a webinar without talking about AI, sadly not. But there you are. We hit the buzzword. So yeah, there's certainly having a paper trail in place is prudent. We're in the investing world. We're going to have to talk about markets at some point. We always say at Albion, we're not that big on market commentary, because particularly if you've got a long-term view, what's happening, this month or this quarter or this year is largely irrelevant. But there you are. End clients aren't going to think that way. We have to get a sense of what's been happening in markets. It helps with delivering portfolios to end clients, understanding their concerns, and really helping. It can help answer client questions in a very simple way. If you've looked at markets and they've asked a question about a certain fund, well, it's going to give you straight away those easy talking points that says, well, yeah, we actually did review this in the last investment committee, and here's what's been going on, type thing. So important to have a sense of what's been going on. Challenging the philosophical approach is key. Does it still make sense philosophically where we are? If that's having a well diversified, low cost, market accepting approach, does that still make sense based on the academic evidence out there? The governance review is probably the meat of the investment committee. So assessing research, reviewing asset classes, and looking at assumptions for those asset classes. So, example, in the last few years, something like private credit or cryptocurrency has come up a lot in the media and whatnot. How do those things filter through to portfolio construction? Do they change your approach at all? And then any financial planning matters as well. You probably wouldn't go through all of these every meeting, all of these 5 pillars. You might focus on a couple, and then, but certainly you should touch on them all through time, to varying extents. The model portfolio review, then we've looked at the philosophy, we've accepted. We think it's sensible to remain where we are, and we've been through the portfolio construction approach. We think the models are still suitable, or we've made changes, discussed changes. You then need to go through a monitoring process for your incumbent solution. So fund and portfolio monitoring, the fund screening process, and perhaps some peer group comparisons. You're not necessarily going to look at a peer group and say, well, look how much better we're doing than them, or look how much better they're doing than us. This for us is about saying we've got a solution that has this philosophy. Are we broadly in line with others out there that might have a similar approach? Because if we're not, then something's going wrong. I mentioned earlier, if you have discretionary permissions, then rebalancing is certainly a key thing to monitor. Even if you're advisory, it's prudent to understand where clients may be at. If you're recommending a 50% equity portfolio or a 60% equity portfolio, and their portfolio, because of market movements, is at 68% or even 70%, you might feel that's material enough to do an ad hoc rebalance, or you might at least document that you've discussed it, and therefore there's no action. You're comfortable that the upcoming rebalance in a month's time is going to sufficiently mitigate that risk. Then finally, some form of risk review, and this is a screenshot here of a document, a sort of dashboard that we feed into our clients' investment committee meetings. But there are those sort of qualitative risks that sit out there, whether it's a regulatory risk, whether it's an investment process risk, or a market-led risk. But having some sort of process for bringing those discussions to the table is also key. It could just be bullet points. Not all of our clients use this tool. They might just be, look, we've got some bullet points, let's discuss them. But you can imagine the sorts of things that get raised here. Oh, I think someone's raised a hand. Is that a question from Adrian?
Maybe. Sometimes people have a little slip of a finger and their hand goes up, and they actually don't mean to put their hand up. We
Adrian, if you do have a question, we got questions at the end, so I'll come back to you, Adrian, for sure, if you've got a question.
He's now panicking, thinking my hand is firmly up, and I don't know how to take it down.
It's the virtual hands up of Zoom. Monitoring risks, a key part of the process as well. And having a process for that is key. And then obviously any other business, that could be anything. But yeah, that we'll see. I've just thrown that on there as well. So hopefully now you've got a sense of why change is required, who's responsible for it. The final section, which is a shorter section, is just going to be insourcing and outsourcing, and what options are out there to you. So first of all, how does the investment committee oversee the investment proposition? So this is, I guess, taking a seat in Albion's seat and some of the tools and things we might look at. Not to say if you were insourcing everything, you would necessarily look at all of these places, but at least it can give you some ideas of how you can efficiently monitor and manage your investment proposition. So there's all sorts of things we need to keep an eye on, but we sort of boiled it down to 4 key areas perhaps. And the evidence itself, obviously you could go directly to the academic papers. I'll be honest, I wouldn't recommend that, because having read plenty of academic papers myself, they're not always a page turner. They can be a tough read, that's for sure. But obviously there are tools available to us these days to make that more manageable. I'm going to use the buzzword again. The chat GPTs of this world, the co-pilots of this world, incredibly useful to digest complex material more easily. Proceed with caution. Obviously, they can make mistakes. but there we are. The media, the Financial Times, and others out there, they do a reasonable and sometimes a really good job of assessing new research and making it more digestible. There's some really good stuff that ends up on the FT in particular, but other places too. It's 2026. It's not all about reading and trawling through academic papers. There's podcasts, there's video content now, and there's some really high quality stuff out there. Some of my favorite podcasts: The Rational Reminder, for sure. There's the Making Money podcast. There's The Rest Is Money. There's The Trap guys. YouTube content as well. Ben Felix, his videos are absolutely phenomenal in the investing space. But there's lots of ways you can easily digest the latest and greatest evidence. And the final one I've thrown up Spiva there. That's S&P's index versus active study. But there's all sorts of regular high level data sets that get published for free that you can go and look at and help sort of justify your approach to investing, whatever that might be. Spiva is just one of them. There's hundreds out there. So looking at more sort of goals and constraints, then I guess a bit more qualitative here. We are going to need some data. There's the likes of Morningstar and FE. I think a lot of our clients use FE in particular. Morningstar is perhaps a bit more technical, but we ourselves use Morningstar. It's phenomenally detailed data that they have available to them. So might be too much, but there's a free tools as well. Koifin, Portfolio Visualizer, definitely recommend you checking those out. I think there's some even more modern ones now. Mabel Insights, I believe, is a new one, but there's plenty out there that you can get for free, or at least for relatively low cost too. Obviously, there's always the option to build something in-house as well, which might take up a little bit too much of that governance budget, but there you are. Research affiliates I would mention, but alongside the likes of others out there as well that have their own suite of tools online, and one of them is an asset allocation kit. A asset class assumptions kit. Asset class assumptions are sort of difficult to arrive at why you've made assumption X, Y, or Z. We do that process every couple of years. It can be quite technical. So again, you can outsource that process to someone like Research Affiliates who they have a paper on asset class assumptions that they release for free. Monitoring the models and products themselves. I could have put Morningstar and FE up here as well, but I've used some different names for sort of sake of difference, really. But there's Bloomberg, FactSet, MSCI. There's the product providers themselves. You should be wary if you're going to product providers for support on certainly at the portfolio level, because if a product provider is not telling you their products are best, then something's probably going wrong there. But I guess you have to take some things with a pinch of salt. But certainly Vanguard, Dimensional, and BlackRock in particular, I know there are loads others out there. They all have tools available, but those three in particular we work reasonably closely with at Albion. They have some fantastic tools that you can use to assess your portfolios, to understand where they are, what they are and aren't doing. So yeah, certainly leaning on product providers too, with that caveat that you want to make sure you're staying independent there. Third parties, the Landcat, I know are big in the platform space. I have some useful tools around the platform space. The platforms themselves, I think you can get a Morningstar X-ray on AJ Bell, and I think Transact has something similar too to help you assess where your portfolio is at. So certainly shouldn't rule them out. I think some of the more modern tech-based platforms as well, the likes of Fundment and P1 platform, all sorts of exciting tech available on platform to better and make your life easier as an advisor and as an end client. Again, building things in-house, but accepting there's a governance budget we have to use wisely. And then finally, one thing, keeping an eye on the regulator. There's not too much to this other than to keep an eye on what the regulator is saying. That can be going directly to the regulator on the website, or it could be an internal or an external compliance function. So final slide then, what options have you got in terms of outsourcing? I've rattled through that in the interest of time, but there are all sorts of things you can outsource as and outsource properly as well. I'm not talking about you know like getting rid of it because you don't want to do it. It's outsourcing to someone who does that day in day out, and there's lots of options out there. So outsourcing the research and portfolio management process, that's obviously where we sit. There's others out there too, and the execution as well. I would say if you're looking to outsource those elements, then be wary of your roles under consumer duty as a co-manufacturer of the investment proposition. We've actually just released a white paper on that particular topic today. QR codes in the top right. But you can outsource compliance. You can look at regulatory consultants. There's back office, client comms. An element of what we do is client comms for sure. But we need, again, aware there's others out there to assist with client comms, tax planning and accounting and power planning. And obviously there's collaboration too. I mentioned it already, but there's never going to be, there's never enough advisors to serve who are out there. So although it's a competitive industry, there's, ultimately, if we can strive to be better as an industry and reach more people, then that does benefit everyone. So leaning on each other as well. Definitely one thing we enjoy at Albion is connecting people through the Albion community and working on best practice and helping each other out for sure. So on that happy note, I'll summarize by saying there's all sorts of sensible reasons to avoid a set and forget process. Your ongoing governance process should be manageable, it should be understandable, and it should be repeatable. And if it's not, then certainly look to make changes or shift around your governance budget. Spend that governance budget wisely. If you're doing too much of one thing, maybe look where you could, you could claw back time and at the expense of financial resources, maybe. But could be a very valuable thing to do. And then finally, in-source and outsource options exist. And there's all sorts of, you can mix those approaches together, to help manage your governance budget. Hope that was useful. We've finished just in time, so hopefully we can get through one or two questions. But I really hope that was useful for you.
Mate, that was very good indeed. Thank you very much. What I'll do is I'll just stop. There you go. Stop sharing. Just while I just highlight a few things. James, we've had a couple of questions come in the chat. If you want to just go back to, I think, Chris, and we'll bring that up to talk around co-manufacturing and co-management, if you like. I just want to bring it to people's attention as well that the feedback form, I've put a link in today's chat section as well, and I'll just bring that back to the bottom. There's been a bit of a technical issue to have it come up as you leave the webinar. So here's the link again, if you wouldn't mind just clicking on it and give us some feedback on today's session. That'd be amazing. After today's session, you'll also get an email from Jade with a link to complete to get your CPD certificate as well. So please do keep an eye out for an email today from Jade with your CPD certificate. We can fall into your junk folder, so do check your junk folder if you don't mind. So yeah, mate, really good. Couple of questions from Chris and James. Also, Adrian, you're still in the lobby. You've still got your hands up. Do you want to come forward with a question? This has been the first time in the Financial Planning Club's webinar history that we bring somebody onto the dance floor to talk directly to James. But if you've got a question, mate, please do let us know as your hand is up. So, James, on that from Chris, the co-manufacturing side, the co-management side, just talk a bit about that.
Yeah, co-manufacturing. I've got to caveat this from the top and say we're not, compliance consultants, and you should certainly take advice where you need it. But we actually have released a white paper today on this, and Tim, part of our team, did a big piece on this last year, which is why we wanted to release it as a white paper, because I think there's a lot of scaremongering out there about what it means to be a manufacturer versus a co-manufacturer and what your responsibilities are. There are different responsibilities and things that are required of you if you're a co-manufacturer of an investment proposition, and they are incumbent on you to ultimately be responsible for the investment value chain as an advisor. I'd encourage you, Chris, to download that white paper and have a read, because whilst it is different and there are things to consider, it is not like it's sort of, it's not a total revolution to how you're doing things. It's simply an evolution of where you were if you were looking to work with a discretionary investment manager, as you indicate you are. Um, just be wary of what those responsibilities are. Um,
Absolutely. And you've seen a lovely one here from James. The
yes.
changing risk levels.
Okay, so James Bailey, thanks for the question, Chris, and thanks for the question, James. How do you take account of changing risk levels? For example, if you measure vol through standard deviations and measures which rely upon the standard deviation, then we can go through periods where vol appears to be relatively low. In these situations, investments which are inherently higher risk can come across as lower risk under current market conditions. Portfolios could be skewed and not fit with wristbands. Yeah, that's a great question, James, and a very pertinent one, because certainly in the last, I'm going to boil down the last few decades into a one liner here, but both stocks and bonds relatively, relatively one directional for the last couple of decades. Bonds have obviously been poor for the last decade, low rate environment, rising yields. But certainly since the 80s, both stocks and bonds have looked relatively low on the volatility, side, certainly relative to how volatile we know equity markets can be in the short term. So you're absolutely right to say we can't rely on just backward looking analysis, or backward looking analysis over any one time period. And that's a huge challenge with investing, is so much of what we conclude about investing is time period specific. So I had a screenshot in here of a model that I removed because it was like, it's probably too much, but backward looking and forward looking processes are key. Running multiple scenarios as well. You might have had a 15% volatility assumption, but 20%, is that more prudent during times of high market stress? What does that mean for your clients on the downside? It's just about having a, a multiple layered process, and not just focusing in on what's happened over one time period in the past. But it's a really good question, James.
So, unless anybody else has got any questions, it's Friday. We're the second week into Jan. The sun is shining, as you can see, beaming through. We've had some freezing weather and some wet weather over the last few weeks. I hope everybody is set up and ready to have a great year this year. If you've got any questions, please do, as I said, just fire away. If not, have a great Friday, have a great weekend, and we hope to see some of you attend our next webinars. But please do complete your feedback form for us today, just so that we can feed back to James and we can continue to improve our session. So thank you all very much for joining us today.
Yeah, thanks very much, everyone.